All right, let's jump right in. Today, we're going to break down an expert analysis on a really interesting company called Gravita India. They're right at the heart of this huge global shift towards sustainability, so let's dig in.
Now, to really wrap your head around this company, I want you to start with a question. Picture a mine. You're probably thinking of digging, deep shafts, extraction, the usual. But what if the world's fastest growing mine wasn't buried in the earth at all?
Well, here's the twist. This new kind of mine is literally all around us. It's in our cities, it's in our scrapyards, it's in all the stuff we throw away. We're talking about urban mining, the art of turning what we call waste back into wealth. And that's exactly where the story really gets going. Okay, so first up, let's talk about the massive trend that makes a company like this even possible. And believe me, this isn't some niche little idea. It's a fundamental shift in how we think about the stuff we use every day. Check out this number because it basically powers the entire industry. According to the analysis we're looking at, recycling aluminum saves 95% of the energy compared to making it from scratch. Let that sink in. 95%. That single fact creates this incredible economic and environmental tailwind. It's a no-brainer. And all of this leads us to a really important concept, the circular economy. It's a pretty simple but incredibly powerful idea. Instead of the old way, take, make, and then just dispose, the new model is take, make, and reuse. It's a system that's actually designed to get rid of waste, and in doing so, it turns a huge global problem into an even bigger business opportunity. And you know what? This isn't just a feel-good idea. The report makes it super clear that governments are getting behind this in a big way. We're seeing policies like extended producer responsibility, which basically makes companies responsible for their products from cradle to grave, and also some pretty favorable import duties on scrap metal. All of this is creating a massive runway for companies in the space. So with that powerful trend as our backdrop, let's zoom in and meet the company at the very center of this analysis, Gravita India. So who exactly is Gravita India? Well, the source material paints a clear picture. They're India's top dog in aluminum recycling, and a huge player in lead recycling too. But here's the kicker. They're not just an Indian success story. They've got a serious global footprint, with operations in places like Ghana and Mozambique. They're proving that this model for turning waste into wealth can work just about anywhere. Okay, so we know who they are, and we know the industry they're dominating. But in a market that's pretty fragmented, you have to ask, how do they win? What's their secret sauce? And really, this is the most important question for any investor, right? The recycling world has a lot of players, from tiny local shops to bigger operations. So what is it that sets Gravita apart from the rest of the pack? Well, it all starts right here. In India's organized aluminum recycling market, Gravita isn't just a player, they hold a massive 30+% share. They are the clear leader, and that kind of scale gives them a huge advantage. The report we're looking at really boils their competitive edge down to 3 key pillars. First, there's the scale advantage. Their massive operations mean they can achieve cost efficiencies that smaller guys just can't touch. Second, they've built out a global supply chain. This is a super robust network for both collecting scrap and selling their finished products around the world. And third, brand recognition. They've built a solid reputation for quality and sustainability, and that's a huge deal for customers who care about where their materials come from. A strong story and a great market position are awesome, but it all has to be backed up by solid financials. So let's pop the hood and take a look at the numbers presented in the analysis. So, this is the moment of truth, isn't it? Does the company's financial performance actually live up to the hype? Let's see what the data has to say. The first number that just leaps off the page is this one. According to the report, Gravita's profits have grown at a compound annual rate of 28.5% over the last 5 years. That is just incredible, consistent growth. It proves this isn't just a nice story. It's a high-performing business engine. Next up, a really key measure of profitability, return on equity. At 18.2%, this tells you the company is super efficient at making profits from the money its shareholders have put in. It's a clear sign of a really well-run, profitable business. And finally, let's talk about risk. This number here is the company's debt-to-equity ratio. At just 0.65, it shows they haven't gotten carried away with borrowing money. They've grown in a smart, prudent way, and they've kept their balance sheet strong and healthy, which is exactly what you want to see. Okay, so the past performance is impressive, for sure. But we all know investing is a forward-looking game. So what does the road ahead look like? Let's take a look at the opportunities and, just as important, the risks. The report lays out a really clear strategy for future growth. First, the company is aggressively expanding its capacity to keep up with all this rising demand. And at the same time, they're looking to expand geographically, exploring brand new markets in places like Southeast Asia and South America. They are not just defending their home turf, they are absolutely on the offense globally.
But of course, no investment analysis is complete without looking at both sides of the coin. The bull case is pretty clear. They're a market leader in a growing, sustainable industry with strong tailwinds. But the bear case raises some valid points too. They're exposed to the volatility of commodity prices, and there's always the risk of more competition jumping in. Seeing both sides is critical.
So, what's the bottom line? After looking at the business, the finances, the future, how does this analysis actually value the company? Let's find out. The analysis uses a model to map out 3 potential futures. In a bear case, if growth slows down, the value is estimated at around 1,850 rupees. The base case, which is seen as the most likely outcome, puts the value at 2,450. And in an optimistic bull case, if they really knock it out of the park, the value could be as high as 3,200. This gives you a really clear range of possible outcomes. In this quote from the report really sums up the final takeaway. It says that despite the risks, the valuation offers a reasonable margin of safety. That's just an investing term for having a bit of a cushion, a buffer against things going wrong. And it's there because of the high quality of the business and its clear path for growth. And all this leaves us with one final big picture thought. As the entire world keeps shifting towards a more sustainable, circular economy, the value we place on the companies leading that charge is changing. So the ultimate question isn't just about today's numbers, is it? It's about what the future price of sustainability itself is really worth.